Thanks, Jun, for the quick summary of significant events that we actually see happening around the global economies today. Before we actually talk about some ideas that we're actually very excited over for the year 2019, I'll first talk about some of the ideas we actually had for the year 2018 and how they actually played out. So, for the year 2018, one thing we definitely can agree on will be the recovery in the Singapore property sector in the early part of the year. With that, we actually started selectively investing into construction companies that we believe would be able to ride out the construction wave from the increase in demand from both the public and private sectors. We do see this persisting into year 2019, where the government has actually announced that the value of construction contracts to be awarded is expected to be roughly between 27 billion Singapore dollars to about 32 billion Singapore dollars. And this is actually despite the cooling measures June actually talked about and the delay in the high-speed rail. Furthermore, this figure is actually a 23% increase in construction demand compared to the year before. Some of the construction theme ideas we actually had in the year 2018 was such as Lien Bing Group and OKP Holdings, where we actually still invested in both companies. I'll talk a little bit more about Lien Bing Group, and it's something that I've actually shared in last year's The Age Investment Conference in December as well. So, for Lien Bing Group, one thing is that their construction order book is at a record level of about 1.29 billion Singapore dollars, and this will actually provide the company about 5 years worth of revenue visibility based on 2018 revenue numbers as a gauge. Additionally, the construction industry in Singapore is actually getting much and much tougher due to such as government regulations, where workers' levy is actually increasing, and Singapore construction firms are actually facing more intense competition from Chinese construction firms. This is actually all squeezing the margins within the construction industry. However, for Lien Bing, because they are both a contractor and a developer, we actually do believe that this will actually help them ride out such stiffer competition. Furthermore, in terms of the property development side of things, Lien Bing has actually very strong partnerships with Oxley Holdings. This way, they are actually able to diversify out their risk over several projects such as the recent Rio Casa and Serangoonville, where Lien Bing only owns about 20% of each project. Lastly, Lien Bing has also been building up their investment property segment, where their most recent purchase will actually be the commercial building Wilkie Edge. Having such an investment property segment will actually provide them a steady stream of rental income, helping Lien Bing smoothen out their lumpiness of their construction earnings. Another major theme we actually talked about last year would be the luxury watch industry in Hong Kong. You can actually find out more about this in our previous Fund quarterly letters and an article that I actually wrote for the Age Singapore magazine. The idea is actually very simple. Luxury watch retailers were actually very hard hit by the corruption clampdown in China from 2012 onwards, where Chinese consumers were absolutely fearful of spending anything from luxury watches to premium baijiu. However, come 2018, we actually saw this turning around, where we saw a new class of consumers emerging, where the Chinese middle income population was starting to spend on luxury goods once more. Furthermore, the rents in the core shopping districts were actually facing a rental reversion downwards. This is because due to the slowdown in the sector, many outlets were actually unable to afford such high rents, and they just simply started closing down shops without even renegotiating contracts with their landlords. Hence, landlords actually had to start cutting rental rates, and we actually see rental rates coming off in the core shopping districts in Hong Kong. With this, we actually anticipated that the luxury watch retailers in Hong Kong to actually become more profitable once more, since a company's bottom line is essentially dependent on two main parts, revenue and cost. If revenue is increasing and cost is coming down, the only thing it could actually mean is that the company's bottom line must improve. Some of the luxury watch retailers that we were actually invested in last year were such as Oriental Watch, Emperor Watch and Jewelry, and Heng De Li. For Oriental Watches, the thesis actually played out as what we actually expected. The company's valuations actually started revaluing to fair value of about 0.54 times book value, and we subsequently actually sold off our position in the company. However, for Heng De Li, while the company actually did turn profitable, valuations did not revalue as quickly. Furthermore, come the second half of 2018, the US-China trade war happened, which resulted in the depreciation of the Chinese renminbi and the decline in Chinese consumer spending once more. Given such factors, it weighed on the valuations, and we are actually still invested in Hang Lee. In the long term, we actually still do believe in the return of such luxury spending, and we're actually still invested in Hang Lee, as I mentioned before. Another point to note would be we actually initiated our position in Swatch again in light of valuations being depressed again. With this, I would actually like to pass back the time to my partner Jun, who would actually share more about some of the interesting ideas that we actually see for the year 2019.